Hey, what's up, everybody? It's Monday, August 19th. Another big day up in the market. We got 7 up days in a row. We're now like just about 1% below record highs in the S&P. One thing I don't like to do, which I've done in the past, but I've stopped now. It's been a while that I've stopped. I don't like to migrate into explanations or language that incorporates emotion or lack of strict analytical approach. For example, what I'm saying is like, it's very common when you hear people say like, it looks like the market's going to do this or that. Like I could sit here and say right now, it looks like the market is going to make new highs. And it may very well at this point. I mean, we have Powell speaking at Jackson Hole Symposium this week, and all it'll take at this point, because we're 1% from the record high, all it'll take is for some dovish comment to come out of his mouth, and you know what's going to happen. We're going to easily surpass the old highs. But still, I don't like to say, I just, as a matter of discipline, as a matter of sticking to my analytical approach, as a matter of being non-emotional, I've spoken about this before in terms of the language that I use. I don't like to use like emotional language. I don't say things like the market's tanking, the market's crashing, it's a melt up, this and that. Sometimes I might slip up. Sometimes I might say that. In the past, I used to use that terminology all the time, like everybody does, like we see in the headlines. I don't like that because it puts things into the mind. It puts things into the brain that trigger emotion. And then once you trigger emotion, then you start to behave in a different way. And so I don't say that. So where it would be very easy to say right now that it looks like the market's going to make a new all-time high. I am sticking to my analytical approach, which is the slowdown in the economy. I mean, we've seen that in the data. We saw it in the Atlanta Fed's recently revised third quarter outlook of 1.99%, which is down from 2.9%, which, by the way, that 2.9%, that included that very strong retail sales number that we had I believe it was last Monday or last Tuesday, which triggered this whole thing back up. And right now, like, if I were to surmise or speculate on what is the reason for the sharp rebound that we had, two things, and I've been talking about those things. Number one is conditioned response. Like now investors have been conditioned to buy the dips, just like they were conditioned to sell the rallies in late 2022 when I was talking about that at the time. And I said, not a time to sell the rallies, was a time to buy. And so now they're conditioned to buy the dips, which ordinarily, I mean, that's a good thing. I don't frown on that. I tell my subscribers that, the way to build wealth, which is why ostensibly we're in this game, like to build wealth, is to accumulate good assets over time. And you want to do that when they're on sale, when they're cheap. All right. But the other thing is I do look at the macro picture. I do look at the forward outlook, and I try to analytically come up with a forecast of what that's going to look like. And I've been telling you guys that the economy is going to slow down because of a drop in net government transfers. That actually has been happening. Okay, we had a 3.2% growth rate at the end of 2023. We're at a 2% growth rate now. So it's not a precipitous slowdown. It's mild, okay? But what I've been saying is that as soon as the Fed starts cutting rates, and I give you that there may be, another leg to this rally based on the rate cut, which is going to bring people in who, have been sitting on the sidelines, waiting for the green light to come in. But I mean, my recommendation if you're not in this, or if you're thinking maybe you're out thinking there was going to be a pullback and it's not happening, my recommendation is buy treasuries, buy treasury ETFs. That's where you're going to get the bang for the buck. I mean, when the central bank starts setting rates one way or another, that has a direct effect on bond prices. So, I mean, rather than get all excited about a stock market, which I believe is quite a bit stretched in terms of the upside, particularly given the slowdown in economic activity, which I'm telling you, again, it's going to get worse with these rate cuts. It's not going to get better. And like I say on every video now for the past month, we're going to come back and we're going to revisit what I've been telling you guys, because nobody else is out there saying this stuff. If you feel left out, if you feel like I got to do something, like you got FOMO, out the wazoo, then get into the bond market. Buy a treasury ETF, buy treasuries, go long interest rate, treasury 10-year note futures on dips. Build a position there. The other thing I want to tell you is that this dollar decline, which we have seen, and now it's going into, I don't know, maybe the sixth or seventh week, that's not going to last. It's another example of, this is classic reflex monetarist reaction to, the Fed's going to cut rates, and that's going to be bearish, for the dollar. I mean, like if rate cuts were bearish for the dollar, then the opposite should be true, that rate increases are bullish for the currency. I mean, we saw rate increases in Argentina, we saw rate increases in Turkey, we saw rate increases in a lot of places, and that just decimated. And by the same token, the yen was very steady. And even though it has dropped a bit, in the last, year and a half, against the dollar, it's still relatively steady when you look at its performance over that period of time. So, and that is with negative rates, and recently a very small increase to a positive rate. So that's not going to last. That's not going to last. I'm telling you this right now. That is another opportunity right now. If you have a medium to long-term perspective, if you're a Forex trader, if, that's just sitting out there that's like a beautiful, ripe fruit, low-hanging fruit, just begging to be picked. All right, it's the best analogy I could come up with. Like, it's funny because people, they chase after stuff that looks, it's almost like it looks like it's there, but it's not really there. It's a mirage. I've said this in the past. And I've said in the past that if the market was a living thing, if it was a being, its job would be to fool you, and it would be very, very skilled and adept at doing that. Okay, it fools most people, and that's why most people make very little money from the stock market, not because they're doing something wrong, but what they're doing is, what's wrong is their behavior, okay? And they chase after things that are obvious, that look obvious, and they shun things that look dangerous or scary. And, that's just a bad way to operate. That is a bad way to operate. So the other thing going on here, like what I've pointed out so many times, not just in the context of what's going on right now or what is about to happen right now with the rate cuts, but I've been pointing this out over years in doing these videos, is how the monetarist coterie, the monetarist, institutional thinking is just completely wrong because they only use a single variable analysis, and that single variable analysis leads them astray every single time. It may not show up in an instant, like Jesse Livermore said. I've recounted that story so many times when his friend told him, hey, you see, Jesse, the market doesn't lie. And he said, that's right, the market doesn't lie, but it doesn't always tell the truth on an instant. Classic line. I have that memorized. I have that, memorized absolutely because it's just a great thing to remember and to repeat every now and then that, things take time to manifest, okay? And a lot of people expect things like, this is why giving videos every single day, it's actually a tough job. You may not think so, but it is, because I want to make it interesting for you guys. I want it so that you learn something. I want to impart some understanding about what's going on. But a lot of the day-to-day stuff is just noise. It's just volatility. It's just fluctuation. You got to be able to step back. Like I've said so many times, get that 30,000 foot perspective. You're flying over New York City. You're flying over Manhattan. Those big, tall buildings, they look like a little nothing. You would think, oh, if I had just one of those buildings, I'd be a rich person. I'd be a very wealthy person. There's thousands and thousands of them, okay? You get that with perspective. You got to step back. So getting back to my original comment, it's why I really, really try to stay away from language or analysis. It's not analysis when you say, this looks like it's going to do this. Looks can be deceiving. We all know this, okay? But yet, how often do we rely on this kind of, analysis? It's not. It's not. That's an emotional thing that is totally subjective. It's not objective. You have to have a process. And the process has to be tied to some kind of solid analytical framework where there's a real understanding. You can't just say something looks like this. You know how many times if I went back and spoke about or recounted my history as a floor trader on the exchanges, and how many times I said, it looks like the market's going to crash, and I'm selling, and guess what? It went right up into my face. So many times, and vice versa. When I said, oh, this thing looks like it's going to go up, it's pushing against those highs, it's going to go up, I'm a big buyer in the pits, and boom, it goes right back down. You cannot rely on looks like. I mean, if you say it looks like and you get it right, you know what that does? All that does is reinforce a bad behavioral approach, a bad analytical, it's not even analytics, it's just a bad behavioral approach. You connect that, hey, when it looks like something, that must be the time to act. And that is not analysis. That is setting yourself up over time for ruin. I mean, I don't know what else to tell you, but we all fall into this trap. Even now, I fall into this trap sometimes, and I catch myself. That's the thing, I catch myself. Do you catch yourself? You have to. And sometimes the best thing to do, is step away. You got to step away. If you're sitting there every day looking at the screen and looking at prices fluctuate and looking at what did the S&P do today? What did the NASDAQ do today? I told you in October 2022 that the market was going to turn around, the economy was going to turn around. The interest rate hikes were not going to pan out the way everybody thought, with a crash and a depression and a recession and everything else and a smash. And I'm telling you right now that the rate cuts are not going to turn out the way everybody is talking about. And it would be very easy right now. And maybe even I didn't say it. It didn't come out of my mouth. I used it as an example. but it would be, you could say, well, you kind of said it, Mike, but I didn't really say it. It looks like we're going to make new highs, but I'm telling you something. I sent out an email to my subscribers today exactly on this subject. I said, stick to the analysis, stick to the macro view, get some perspective, get that 30,000 foot perspective. All right? We've come a long way. The economy is slowing down. The rate cuts are going to slow the economy down further. This is a given. It is a given. And we will come back to revisit this. So, and I'm not in this for what happened today and what happened yesterday and what's going to happen tomorrow. I'm in it to accumulate and to amass wealth over time. And that's what you should be thinking about too. All right? Charlie Munger, who was the partner of Warren Buffett, Charlie Munger was one of a kind, man. We lost a great guy when he passed away. It was last year, and yeah, man, this dude, he just had a way. He had a way with putting things, and he said the greatest ill, the greatest hazard, the greatest bad thing ever perpetrated on investors was this concept of, somebody going to teach you how to day trade. This guy was not worth the billions that he was worth by sitting there looking at a screen day trading. I'm sorry. His whole thing was about accumulating wealth over time. And when he was asked in a conference, when do you sell? He said, why would I sell? That doesn't mean he doesn't sell. But what he meant was, I don't sell good assets. I wait for the market to come down so I can accumulate more and more and more. What is the definition of wealth? The definition of wealth, the most basic definition of wealth, you know what that is? It's not money. It's abundance. Abundance. I've spoken about this in the past. It's not hard for your eyes to discern wealth and poverty. You go to any country that is poor and you know it immediately like that. You know how you know it? Because they got dirt roads. There's no infrastructure. There's no medical facilities. There's not a lot of food available. People don't have much clothing. Maybe no electricity, no sanitation, no fresh water. You could see it. There's a lack of abundance of the things we need, the real things we need. And vice versa. You could go to a rich country, like countries maybe, like the United States or Japan or countries in Western Europe. And there's an abundance. Stores stocked with food and supplies and fresh water and sanitary systems and paved roads and hospitals and medical facilities and education and stuff like that. Same thing in what we're doing, okay? Abundance means accumulation of good assets. There's an abundance. We should strive for that. We should strive for that. Not like I have a good thing today and I'm getting rid of it tomorrow. What the hell is that? What the hell is that? No, abundance, accumulate. All right? And on that note, I don't have unlimited funds. And I don't know anybody who does. Not even freaking Elon Musk or Bezos. Although, in the context of humans, they kind of do. But even those guys, they don't have unlimited funds. So there comes a time when, in my case, I raise some cash because, I've done well and the market is way up and I see economic growth slowing down. And that cash allows me, when things get cheaper, not cheaper like, necessarily in a price sense, but valuation wise, when it's a better value, I should have used that phraseology. I have the cash to invest in, I don't have unlimited. If I did, I would never sell anything. But sometimes I got to roll out of some positions. And there are actually times when it's not just a case of having to raise cash. It's a case when my assets, my holdings have reached their fair value. By the way, I have a course online on my website called MMT and Value Stock Selection. It shows you very simply how to choose your own stocks. You don't have to have a stockbroker, if they even exist anymore, or Schwab, or ask these people. It's $99 on my website. So that's why I raise cash, because sometimes I need it based on my outlook that I think there's going to be an economic slowdown or an economic contraction, and I want to have funds available so when those great assets come down to a level that really, really is an opportunity, I want to be able to get in. See what I'm saying, folks? Anyway, I forgot to say this. Please like and subscribe. I hope some of you lasted to the end. It was a long video. By the way, if you lasted to the end, please leave it in the comments. Thank you very much. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. It costs you nothing, 30-day. Check it out. Learn something. Learn about the economy. Learn MMT. You won't be sorry you did. Believe me. All right. See you tomorrow. Bye.